Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're looking at Zoom Video ahead of its upcoming earnings release. But before we get into everything, I want to say remember to subscribe and leave a review wherever you listen to your podcasts. And make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. All right, so at this point, most people have heard of Zoom, even if you're not an investor. You've probably Zoomed at some point during this coronavirus stay-at-home push. The stock trades under the ticker ZM. And as we sort of alluded to already, it was really one of the first star coronavirus lockdown stocks. So now we're going to dive into what's going on with the company to see if investors should consider buying Zoom stock with it set to report its second quarter fiscal 2021 financial results that are due out on Monday, August 30th. So next Monday. So we're just going to jump into the company. If you know about it already, you can fast forward if you want. Zoom offers people relatively the ability to connect via video, voice, chat, content sharing, and more. The firm, which went public in April of 2019 at this point, so about a year and a half on the public markets, boasts that its cloud-native platforms can connect what it calls thousands of people in a single meeting across disparate devices and locations. Basically, it's made for our digitally and globally connected world today. And as you can tell, this made it a nearly perfect stock to outperform the market during the lockdown situations. Zoom's platform has expanded during the coronavirus with businesses, schools, governments, and really people all over utilizing the video-based communication platform to connect with either their office or friends, family, all of that. The company offers a free version of its service, which it hopes you then like and then use one of their paid subscriptions, which they sell on a monthly and yearly based subscription. So these plans include what they call a platform that's great for small teams, small and medium-sized businesses, and then large enterprises. Those prices range from $149.90 per year per license for that small teams, which is based on 9 licenses per account. So you have to reach a certain threshold. And then there's one for, as I said, small and medium-sized businesses that's basically $200 per year per license. And then there's another one for large enterprises that's also that $200 a year per license price point. But you just have to have, it's starting at 100 licenses. So you have to have 100 users. In the small and medium-sized businesses is 10 licenses per users. So that gives you a sense of how they're trying to make money. They're making money on these monthly and yearly based subscriptions. I believe the enterprise version is only based on, you have to get it for a year. You can pay in monthly installments, but the other ones you could say cancel after a month if you weren't happy with it. But that large enterprise one is on a yearly basis. So as you mentioned, the firm offers its various solutions, and they're targeting different industries at this point. They're now targeting healthcare, such as that, like specifically, they're trying to focus on telehealth, which is becoming more and more important during this coronavirus pandemic, which then could continue to be a big thing after the pandemic, as more people could then just connect via their doctor instead of maybe traveling very far to go to the doctor's office if they have simple questions. So telehealth could certainly be a big business for Zoom, and it's also going to be, in my opinion, a pretty big business going forward. We should note that some on Wall Street have clearly expressed worries that after the lockdowns eventually end, which they already have for the most part, in that people are already starting to go back to work and many are sort of already back in relatively their normal routines, that Zoom would lose its luster. That said, there's certainly no guarantee that big companies, especially in big cities, Zacks is located in Chicago. We live in Chicago. We're not back at our office yet because public transportation makes it harder for everyone to get to work because you don't want to be all stuck on a train car. Big office buildings, elevators, it just makes it much more difficult. So this remote work environment could last much longer than some people think, especially in these big cities. And then firms that find this remote work environment relatively seamless might, over the long haul, even with coronavirus out of the picture, cut back on rent and commercial real estate expenses by just trimming down in office staff or allowing for more flexible stay-at-home work remote schedules. You already saw it. Twitter and Facebook sort of make some bigger announcements already with their plans to have a more permanent work remote basis. And this could spark the larger thing you've been hearing about for years, that they're not going to need these big cities as people choose to work remotely ever. That's not necessarily going to happen, but it certainly could have businesses look at their bottom lines and say, hey, we don't need all of this massive commercial real estate. We could just have a smaller footprint and just have less people coming into the office, where maybe you work 3 days in, 2 days out, something like that. So you just need a little bit less space. Also, there's a long-term pitch, and they've already pitched this when they went public, as just to cut down on business travel in general, to have more meetings instead of getting on a plane. And in Silicon Valley, they've already promoted themselves as a way to avoid unneeded travel, reduce your business's carbon footprint. They've printed lists of businesses that have been successful doing that. And I think going forward, they could get a decent amount of positive publicity doing more of this promotion of this is a way to cut down on travel expenses as well. So long term, it's not just the coronavirus that has Zoom video in a position to succeed in this world of globally connected. Everyone in a business and everyday people have computers, and they're connecting for various things they're doing, from telehealth to talking to friends and family and conducting their business on a daily basis. And we should also note that even before the pandemic hit, Zoom's offerings were clearly attractive because the company was growing pretty substantially. So with this in mind, we're going to jump into more what's going on a little bit recently. So in early July, the firm announced what it calls Zoom Hardware as a Service. It's giving you the acronym of HaaS, everything as a service, software as a service, everything. So they're doing hardware as a service. They'll make their Zoom Rooms and Zoom Phone more accessible. This is what they're saying, by minimizing the friction around hardware procurement. Basically, they're saying that it's going to be easier for you to buy some of the hardware that they have partnerships with various companies such as Neat and Poly and others, where their services are built into some of this hardware that makes people have a more seamless video conferencing ability. And then we should note that in mid-July, the company announced its Zoom for Home video conferencing screen that's aimed at those home office users, which is going to be a bigger and bigger thing going forward. It's currently retailing for about $600. And that first product that it's offering is a Zoom video call. It's software built into a 27-inch touchscreen that has various cameras, microphones, provides just a better audio quality than maybe the laptop or whatever you're working with at home. The basic plan is to give a more beefed up version of the video conferencing for people that might be working in an office. So it doesn't seem like you're just struggling to have this kind of minimal connection via just your laptop's one little camera. Just a more beefed up version. They're aiming for that at-home office user to have a separate screen that's just for video conferencing, which some people do all day, every day. We should also note that on Monday, so just yesterday, depending on when you're listening to this, they made some negative news, and this is something has happened throughout the last several months since the pandemic happened, that they've had some outages. So on Monday, many video conferencing users reported some problems early Monday morning, which was a big deal since a lot of people were returning to school. And Zoom video for schools is going to become a bigger and bigger thing, as a lot of these schools are going to continue to work remote. A lot of them are going back at least the first half of the year completely remotely throughout most of the United States, from elementary all the way through college. So outages could be a big deal, but the company said they already fixed it. The stock is already back up, and we should note that the stock is probably back up on Monday or Tuesday, somewhat to do with the fact that it announced that it landed a deal with Cardinal Health for what it calls the first or video first unified communications platform. So Cardinal Health, big company, and it could turn out to be a pretty important deal along the way in helping Zoom, which does face some competition. So the more big players that adopt it, the better for them. And once you become a verb like Zoom has, you know you're going in the right direction. It's like Googling something. Zoom has become sort of the go-to video conferencing for its ease of use and its ability to integrate in with other apps in various things. So pay attention, maybe that Cardinal Health deal helping them in the long run. It also ties back into my telemedicine and telehealth point from earlier. And now we're going to look back quickly at Q1 before we look ahead to what to expect next week, just for a frame of reference for the growth they've already done and the growth we're calling for going forward. So it's Q1 fiscal 2021 results, which for the 3-month period ended on April 30th. So it included, its fiscal year is a little different. So this included a decent chunk of the quote unquote lockdown period for it ending April 30th, where most people were ending at the end of March. So the company's adjusted earnings were up from 3 cents per share to 20 cents per share, blew away our estimates as well. And then on the revenue side, revenue was up about 170% to about 330 million, which also crushed our estimate. And then on the customer side, this is hugely important, as it's these business customers and paying customers that are going to be the lifeblood of the company going forward. It closed the quarter with around 265,000 customers with more than 10 employees. This marked a 354% jump from the year ago period and an over 220% climb from the fourth quarter. So a big jump in those smaller business users, 354% from the year and 220 from just the fourth quarter. And on top of that, customers contributing $100,000 in trailing 12-month revenue climbed 90% to around 770. So those big customers are still smaller, but that's good. That's a good sign going forward that they were up 90%. So looking ahead, we should note that the company at the time when it reported in early June raised its guidance following its big pandemic boosted quarter. And now we're going to look into what we're calling for at the moment. So our Zach's estimates are calling for its Q2 revenue to jump 242%. So that would easily top Q1's 170% growth. So we're calling for 240% top line growth. And then we're calling for 462% growth on the bottom line, from 8 cents per share a year ago to 45 cents per share on an adjusted basis. And then if we look ahead, we're calling for 300% growth on the bottom line in the third quarter and about 200% growth on the top line in the third quarter. So big growth we're still calling for this quarter and next quarter. And then on a fiscal year basis, we're calling for about 190% revenue growth from 622 million all the way up to 1.8 billion this year. And then we're calling for a massive jump from 35 cents per share on an adjusted basis to $1.72 per share. So some big growth we're calling for this year. And then if you look ahead, and these are what Wall Street and investors need to be paying attention to, is what does the guidance start to look like for what it's going to be, it's fiscal 2022. So next year, right now we're calling for about 25% growth above that to get all the way up to 2.2 billion, with another double-digit growth on the bottom line as well. Obviously, we're calling for a big slowdown compared to this year, which is going to be a very hard to compare year, as hopefully the coronavirus pandemic is far in the rearview mirror by the time it's fiscal 2022 ends. But it is worth paying attention to, because easily those figures could continue to climb as more and more companies decide what their plans are, more and more schools decide what their plans are for the next several years. And Zoom could certainly benefit from more of this remote environment. So now we're going to quickly look at the stock price before we wrap this up. We should note, so over the last year, so this is since last August 26th, the stock is up 217%. This compares to the broader tech industry's 42% climb, so up about 220% compared to 42%. And then if we look just in 2020 so far, so since the beginning of this year, the stock is up 330% compared to the tech industry's 25% climb. So this is up from $70 per share right at the beginning of the year to sitting right where it is on Tuesday morning, which is right near its recent highs of $295 per share. We should also note that this includes about a 25% climb in the last 2 weeks after it slipped a little bit recently. So it's really on a nice upward trend heading into earnings next week, up 25%. And as of this recording, it was up about 3% through morning trading on Tuesday. So some big positivity for Zoom heading into its Q2 release next Monday. So that could mean that Wall Street is expecting big things. With that said, Zoom is currently a Zacks ranked #1 strong buy that earns an A grade for growth in our style score system. And this is also coupled with an F grade for value. So that shows that it's certainly that should only be thought of as a pure growth play. At the moment, it remains in growth mode. So don't think of it as its valuations. If you look at its PE or price to sales ratio, they're sky high at the moment. So it's purely a growth play and a bet on the longer term ability for video conferencing to remain very important and continue to proliferate, and also a coronavirus bet that anything that can grow during the pandemic is what Wall Street is looking for, and Zoom is certainly a candidate for that. We should also note that it crushed our bottom line estimates in the trailing 4 quarters by pretty impressive figures. Beat by 100% last quarter, 115% before that, 200% before that, and 700% before that. So it could just, the business is relatively new. It's only been a public company for about a year and a half. So maybe analysts are just having a harder time knowing what's going to happen. Obviously, the pandemic boosted it last quarter, but some big bottom line beats over the trailing 4 quarters. As we touched on a little bit earlier, Zoom does face some competition. This includes from giants like Microsoft, and its insane run so far in 2020 is certainly going to be hard to keep up with. There's obviously going to, at some point, be a pullback, and there's going to be maybe an excuse for investors to take home profits, no matter what it does with its Q2 results. That said, Apple and some other big names have shown that if you're able to impress investors and you're able to grow during this environment, your stock could continue to climb. So it's a little bit of an unknown at the moment. It could face some near-term selling pressure. So it's probably prudent, if you're looking to have this be a shorter-term play, to perhaps wait to see what its guidance and results look like and how the stock trades in the near term after its release. But if you're a longer-term investor, you don't need to necessarily find the best entry point. So you could just keep Zoom on your radar. You could think about it buying now, and just you're going to hold it for years and years, and you won't really need to worry about if it dips back below where it's trading now. Or you could just wait, just to give a better sense of what's ahead, since management will provide hopefully some more solid guidance of what's to come later this year, and maybe what they're thinking from these bigger clients and how the adoption is going along. But certainly pay attention to Zoom, which is set to report its results next Monday morning, so the very end of August. But that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute, an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.